Money on my mind, looking for a dime. James Locke in the house, gonna help you shine.
Hello everyone, welcome. Welcome to the Pool Lock YouTube channel. I'm James Locke. Today we're going to answer two more Ask James questions of the day. First question is from Mark. He asks, how have interest rates reacted to the new tax bill? All right, Mark, that's a great question. And you're probably a regular viewer of our channel here. You're a smart man to know that as you approach retirement or you're in retirement, it's really all about the interest and dividends. And a lot of that can be tied to interest rates. It's also said, of course, as you know, that a lot of people say, like, the bond market is smarter than the stock market, right? The stock market has more animal instincts, but the bond market is more logical. And interest rates on the 10-year government bond went up nearly 0.25% in the days following the signing of the bill into an act. So that means even the bond market is a little bit more optimistic. Now, part of that might be because they think that with this extra stimulus in the economy that the Fed will not be lowering rates quite as much. Maybe it might lower them a month or two later, or might lower them to a lesser degree between now and at the end of the year. And as a result, that helped allow kind of those long-term rates go up. Now, this creates an interesting dynamic for those of us focused on income investing, because when we see this kind of rate movement, it often signals that the fixed income markets are anticipating stronger economic fundamentals ahead. But at the end of the day, I think what really drove those long-term rates to go up was simply, that confidence in the ability for the economy to grow. Now, I know there's naysayers out there always like to say that it's about the tariffs and creating inflation. And we are seeing a little bit of that. But what we also are seeing is some initial signs of a slowing economy. Not a recession or anything bad like that, but the economy is growing at a slower pace. And even with that, the long-term rates have come up. Now, what's particularly encouraging for income-focused investors is that this rate environment creates opportunities across multiple asset classes. We're not just talking about government bonds here, corporate bonds, dividend-paying stocks, REITs, even alternative income investments are all responding positively to this shift. The key is understanding that when long-term rates rise due to economic optimism rather than inflation fears, it typically bodes well for companies' ability to maintain and grow their dividend payments over time. So the good news is that, if you're retired, you haven't completely, made the shift to an income first growth second strategy like we always discuss, or you're not retired yet, but you need to make that transition, now might be a great time to do it. Because again, the longer term interest rates that are tied to a lot of these income first kind of instruments has just gotten a little bit higher and a little bit more favorable. This means better yields on new bond purchases, potentially higher dividend yields from kind of quality companies, and more attractive cash flow opportunities across the board. Remember, timing these transactions perfectly isn't as important as positioning yourself properly for the long haul. The income first approach we champion isn't just about chasing the highest yield. It's about building a sustainable, diversified income stream that can weather different rate environments while still providing the growth component you need to maintain purchasing power over time. Hope that helps. Great question. As always, if you would like to send in your question, you can email them to poollock@poollock.com. Moving on to our second question, and this is from Christopher, and he says, are bank CDs a good investment right now? All right, we get that a lot because interest rates are higher, and it really depends what you're looking to accomplish, right? The interesting thing about most bank CDs is that you get better rates on short-term CDs than you do on long-term CDs. So if you're of 6 months or a year, maybe a year and a half, you can do okay. But if you're trying to lock in good rates long-term, 5, 10 years, you're probably going to get paid a lot less. And that's just because the way banks generally function. Now, what's happening right now in the CD market is particularly telling for income investors. We're seeing this inverted yield curve situation where short-term rates are actually higher than long-term rates, which is, unusual historically. This creates what we call a yield curve inversion, and it's one of the reasons why banks are willing to pay you more for shorter commitments. They're essentially betting that rates will come down over time. So CDs are great for you, right? If you want to make a lump sum purchase, right? If you're saving to buy a car, you've got some money, and you want to pay off your mortgage before you retire in the next few years, then CDs are great. It's a great instrument for that. Or if you want to use the money to pay for college or education or children or grandchildren next few years, it's great. Anything that's a lump sum where you're spending the principal, but if your primary goal is to generate income in retirement, well then CDs generally are not the right answer because retirement is a long-term liability. God willing, you retire and you live for 30 more years, right? That means you want to fund it with a long-term asset. And with the higher paying CDs being a short-term asset, you have a mismatch. You're funding a long-term liability with a short-term asset. Here's another critical factor to consider. Inflation protection. When you lock into a CD, especially a longer-term one, at today's lower rates, you're essentially guaranteeing that your purchasing power will erode over time. If inflation runs at even a modest 3% annually, and your 5-year CD is paying you 2.5%, you're actually losing money in real terms. That's particularly problematic for retirees who need their income to grow over time to maintain their standard of living. And so if you remember, we had a lot of the banks failing, right, 2 or 3 years ago, smaller banks, and part of that was because they mismatched in the opposite direction. They took short-term liabilities and they try to fund them with long-term assets, and that caused banks real headaches. The smaller banks, that is, the regional banks. Well, the same is true if you do the opposite, right? If you fund a long-term liability with a short-term asset, right? For retirement, if you do that for retirement income, that's a problem. We typically recommend diversified approach that might include dividend growing stocks, investment grade corporate bonds, REITs, other income producing assets that have the potential to increase their payments over time. These instruments can provide the inflation protection and growth potential that a CD simply cannot offer, while still generating the steady income stream you need in retirement. So again, if it's a lump sum purchase, the next few years, great, CDs are working, right? If it's retirement income, then I would say that there are much better options. Hey, thanks for your question. So great questions today. If you have a question you would like to send in, you can email it to poollock@poollock.com. And if you like what you heard, go ahead and like and subscribe to our channel. I'm James Locke, your retirement income source, and I'll see everyone next time.
Money on my mind, looking for a dime. James Locke in the house, gonna help you shine. Retirement is near, don't you live in fear. Listen up, my friend, let me make it clear. Savings in the